Okay, we are live and the audio is good. This week I was presenting to about 65 real estate investors who were interested in coming into commercial real estate. And they asked some really good questions, which I thought that I should go over on today's show because I think sometimes what happens is when you're so used to doing commercial real estate deals like I am, what happens is you kind of forget where people that are starting, what kind of questions they have. And so even though I've done a lot of kind of shows up to date, I thought that what I would do is kind of revisit what I think are probably some of the most important questions and the biggest questions that are on new investors' minds. And so I'll set it up a little bit by most of the men and women that were in the audience that day. They are buying for long-term hold, mainly residential. Some people own kind of fourplexes and sixplexes. They'd fixed and flipped. Some of them are doing new construction, wholesaling, lease options. And I think one of the reasons that they're really interested in commercial real estate is right now in a lot of markets, the argument that you're going to get kind of 2 to 3 to 5% appreciation each year, that argument is pretty thin. And so if you're really investing in real estate for cash flow and long-term kind of capital preservation, then I think it's one of the main drivers for considering commercial real estate, because with commercial real estate, you're getting kind of far more predictable cash flow. And I'll tell you, some of the stories of clients that I've worked with here in a minute. But I think most of the questions really fell into a few different buckets. The buckets of the majority were, how do I make money? How do I grow my money? And there wasn't too many on the legacy, which is kind of like, how do I keep my money? But I'll get into that here in question number 3. So like I said, today it's going to be the 5 most frequently asked questions I get on how to invest in commercial real estate. So number 1 is, where do I find the best commercial real estate deals? And I probably should start by saying, I don't think that there's like one way to find the best deals. And what I'm going to share with you are my beliefs and how I invest. It doesn't mean that it is the best way to invest, and it doesn't mean it's the only way to invest. And the other kind of important mindset is it really depends. And so, like I said, I'm going to share with you what has worked for me and what I think, based on my 10 plus years of experience, would work for you. But you really have to kind of vet it and make sure that it does. So question number 1, where do you find the best deals? I always start in my backyard or as close to home as possible. And the reason for that is there's a couple of reasons. Number 1, this is a business, and I like to have as much control and influence over my business as possible. So if I'm investing in a city like Edmonton, which is 3 hours away from me, or Houston or Phoenix, and these are places that I invest in, but I wouldn't start there. And the reason for that is, after having done this for a long time, I've made a lot of mistakes investing in places that are too far away from me. And it just becomes complicated. Your property manager, really what happens is you're really relying on a property manager to follow the systems and everything that you've got set up. But the truth is, property managers come and go. Sometimes you get a crappy property manager. Sometimes they get sick, they leave. I mean, it's not their business. And so no one is going to want or focus on your property as much as you do. And I like to be able to drive by it. I like to be able to see what the hell's going on. Once you start to amass enough of a portfolio that you can afford to fly down and look at your properties on a more frequent basis, because this is what I do full time. I mean, if I need to pick up and go and look at a property that's in Houston, for example, I can do that. Most of the investors that I work with or talk to, they still have jobs. They might be a doctor, a lawyer, an architect. They might be running their own business. And so for them to be able to kind of pick up and leave to go handle an issue that's 5 hours away, that's really difficult. So Starting in your backyard is key. We talked about A location, B location, C location. I've done another show on that. Just think about it. A as your, the most affluent people that you're going to be dealing with, highest income earners, most expensive houses, fanciest and nicest retail, all the way down to C and D. D would be a war zone. I don't recommend investing in that. But I think if you're in blue collar, which is C properties, and B areas, those are great places because you're going to find the most value add. So that's where I would start. So that's kind of question number one. Question number two is, what type of commercial property should I start investing in? And this was kind of an interesting question because most of the people that are selling how to invest in commercial real estate, they really focus on multifamily. And I get it. I really like multifamily. The challenge I have with that is markets go in cycles. And right now, multifamily, everybody's talking about it. There's tons of courses and podcasts, and because it's by and large the easiest for people to understand. I mean, everyone needs a place to live, right? That's the argument, and it's probably the least disrupted. So I understand why multifamily is kind of the choice for most new investors to get into. But what I will tell you is, I know a lot of very successful real estate investors, and they do not invest in multifamily. They will focus on retail, industrial, office, and there's lots of reasons for that. I mean, there's a concept called triple net leases, which essentially means your tenant pays for all your operating costs, provided it's rented. And so if you've got a retail tenant, for example, like a Starbucks or a McDonald's or a gas station, and they're paying, basically they're paying the rent and they're paying all the op costs, meaning the insurance, the common area maintenance, the taxes. They basically pay for everything except for structural. You know that you can really take care of your property. Whereas in an apartment building, you've got to set that aside to make sure that you've got what's called CapEx or capital expenditures for unexpected expenses that come up. And so, frankly, if I was just starting out, I would look at and ask myself, what do I understand? I don't really think it's that difficult to understand retail or industrial for that matter. Office is a little more complicated, and the amount of money that kind of goes into an office deal is typically in terms of when a tenant leaves and then you've got to refit it as a retail property. It starts to get a little more expensive. But if you've got good leasing agents and a good property manager, then I think that those are considering different asset classes, not just apartments, is key. And what I asked this lady that asked me that question is like, well, what do you understand? Now, she understood multifamily, but I think if we had a 10 or 15 minute conversation, I could have asked her a few more questions. It was difficult because the room was like 70 people. And so to kind of go deep on one question wouldn't have been fair to all the other people that were in there. But I think that if you really were to take a step back and say like actually retail is not that difficult for me to understand. I understand where the best retail locations are, or I work in an industrial park and I actually know lots of the owners in there. I guess to think about it another way is I like to find competitive advantages. And that's why, I on my website, I call myself the arbitrage architect. And really what that means is I'm looking for places and areas that other people are not seeing. And so if you drive by a strip mall all the time and you know that there's some vacancy in there and you're just thinking, man, like if all they did was X, Y, and Z, that owner of that retail property might be someone that lives 5 hours away or out of state or out of country, and they've done nothing with it because they've had it for the last 15 years. And you approach them and you say, hey, I'd love to buy it. And now because you live right down the street from it and you understand the tenants and you understand what tenants should go in there, you can really add value and do some wonderful things. So it's funny that I didn't plan to say that, but it really does tie into question number 3, which is how do you add value and make money investing in commercial real estate? And so I kind of touched on that, but the keys to investing in commercial real estate are as simple as possible. You're trying to increase the net operating income. And that NOI, net operating income is really just revenue minus expenses. So if you are able to push your NOI, that's how you add value. Now, there's going to be some investors that are not interested in adding value per se. They just want stable cash flow. And so one of my clients, a physician here in Calgary, he said, Shane, I'm super busy. I've tried the residential rental thing. It didn't really work for me. I felt like I had a second job. Can you just show me how to park my money and get some cash flow today, knowing that in 10 or 15 years, it's going to continue to grow. I might be able to add to my portfolio and get more cash flow. And so we found him a very stable A-class property, shadow anchored. Shadow anchored meaning it's like around it's in a kind of a master planned retail community, and he's very happy. He gets $6,500 a month plus his mortgage is going down $7,000 a month. And in 20 years, when it's paid off, it'll be worth $5 million, and he can either give it to his daughters or he can keep it, and he'll generate about $25,000 a month. So, I mean, that is what works for him. For other people that don't have 20 years and they want to get it faster, then you're just looking at finding properties that you can that have vacancy, that have rents under market, or that you can expand on. Those are kind of the three key ways. Question number 4, how much money do I need to start? And I mean, obviously it really depends on the size of properties that you're looking at. Here in Calgary, what I would suggest, or even in broadly speaking, you're going to look at about 25 to 35% down. So if you're looking at $1 million property, 250 to 350,000. In Calgary, that doesn't really get you much of a commercial property, but in other communities, it will. Now, what I should say is, just because you need 350, or maybe you're looking at a $10 million property and you need 2.5 to 3.5 million, doesn't always have to be your money. And that's really why it kind of goes into the book that I wrote, Club Syndication, which you can get here for free. Just go to clubsyndication.com and you can just name and email and you get the book for free. I do have an option to purchase it if you want a physical copy, and you just go to clubsyndication.com/book. But either way, if you just want the PDF, I just want to basically get it in the hands of investors. Okay, you know what? I'm just going to get into number 5 because it really talks about how I raise capital for my deals. Okay, so question number 5, what is the best way to partner or structure my commercial investments? So this is, I think what it really means is I don't have enough money, or I'm thinking about taking someone in that has expertise to work with me. And so how should I do that, Shane? And this was a really big topic. This was where I had about 5 people come up after. So I had about 15 people come up and ask me questions after the event or presentation. And I would say that 5 people stayed because they just really wanted to drill down on what's the best way to structure it. Should I do JVs? Should I do a GP, LP? Should I invest in a corporation? And I'll tell you how I do it. And it works for me, and it works for high net worth individuals. And that is, I use a GPLP, so general partner, limited partnership structure. I try to focus on the most tax efficient ways to do that. So I have an accountant, and I'm not an accountant, so I'm not going to pretend to explain all that right now. But essentially what happens is, it's with an LP, it's a flow through. So all the money that's earned in the general partnership flows through out into the limited partners. And then if they invest corporately, they claim corporately. If they invested personally, they claim personally. So I try to keep it as super simple and non-complicated, because if you can't explain it to an investor, then a confused mind will say no. And I think there's way too many people that start out investing in commercial real estate and they try to raise money and they do all these kind of crazy complicated things. And I guarantee if they don't understand it, the limited partner that they're trying to raise money from is not understanding it, and they'll just say no. So, and from a legal perspective, you want the LPs to be, the only risk they have is the amount of money that they have in the deal. So that's kind of, that's the basis of a limited partnership. I explained that as a general partner, especially up here in Canada, I don't know why I said it that way, that you're really going to be signing off on personal guarantees, or what's called, you're giving your covenant. And so there's lots of different ways that that can happen. If you have a company, your holding company that has enough financial wherewithal, then sometimes that can be used. In my case, most of the money comes out and most of my assets are in my personal name. So there's just different ways that you're going to have to kind of give your covenant to a bank if they need it. US is much different because in the US you can generally get non-recourse loans. However, the bank still wants to know who's signing on the lie, cheat, and steal and the carve-outs they call it. So I don't want to get too deep into that because that I've covered that in previous podcasts and shows. What I would say, what I said to this lady is really, it comes down to like, number one, the deal, how much risk is in it? What's your timing? What's the upside? And then from that, what I would really say is like, what's your track record? I mean, if you're just starting out, then you should expect that you're going to have to give up more. If you have experience, you are likely going to be able to raise money much easier, and you might not have to give up as much upside. How much money are you putting in the deal? I mean, if you have very little money that you're putting into the deal, expect that your partners, whether it's your JV partner or whether it's your limited partners, are going to expect more. And then what kind of relationships do you have, right? I gave the example of when I first started out, I was giving away way too much in terms of equity in the deal. I didn't charge enough in terms of fees, but it got me in the game. And now when I go out and raise money, because I've made my investors so much that they don't ask any questions, it's very simple for me to raise the money. And but that's taken like 10 years and paying my investors tens of millions of dollars back over that time. So of course I'm going to have a much easier time. But that's unrealistic if you're just starting out and you've never done it. I give the example of two properties. One, Muskoka, where it was 1,150 acres of a resort development, where we raised our money using to our limited partners at a 12% preferred return. So they would get 12% before we would split. But the back end was 50-50, meaning I thought that there was going to be a big back end, lots of money at the end, and we wanted to participate in that. So we paid them more of a pref or preferred return, and we would split the profits 50-50. The challenge was that the deal took way too long. And so the 12%, when it compounded annually, and we raised all equity, so you can imagine what, $6.5 million, plus then we had to add more money at 12% compounded over 4 years. I mean, if you want to break out a calculator, you're looking at close to $100,000 a month that I had to generate in revenue to be able to pay those investors. So it just became very difficult. And so that was a very good lesson for me. Now I'm not nearly as, I don't think the word is greedy, but I just am more cautious with how long a deal will take. And so on my most recent deal, we did an 8% pref with a 65-35 split. So 65% goes to the limited partners, 35% goes to us. And I only have to pay an 8% preferred return. So those are just different ways that you can structure it. Like I said, there's hundreds of different ways that you can do that. But I think that my book club syndication, even though it's a short read, will explain that in more detail. And I think that you'll get a lot of value out of it. She was also asking about partners and how to find a partner to bring into your deal. And I said, you know what, for me, if I'm going to find a partner, like a true partner, like in the deal together, I want him to be 100% responsible, and because I'm going to be 100% responsible. I don't want someone to come in saying, I'm going to do 50% of the work and you do 50% of the work, and we're going to have all the roles and responsibilities, and we're going to just clearly, like, to me, I suppose that can work. What I've found, though, is that, especially when you're starting out, you don't even know what the roles are. And so then all of a sudden what happens is people start to feel like they're doing more or less or whatever it happens to be. And that's where arguments come in. And so I would much rather everybody be fully invested. We're working together. We're partners. We're going to make this happen. And you just, and that's really how you succeed. If you've got a straight equity partner, then expect that they are saying, you know what, I'm putting on my money and you're doing all the work. And if that's clear, then that can work too. And I've had that relationship and that works fine as well. But it's very clear. It's either like all or nothing, if you will. And so anyways, that's what I would have to say about how to structure your partnerships. Next week, I want to talk about my $13 million mistake. And when I was asked from one of the members in the audience, Shane, like, what lessons have you learned? What can you share with us? I didn't even like, I don't know if I was like, I psychologically blocked this deal out of my mind. But it came to me as I was speaking. And I thought, you know what? I want to share this big mistake with you because I think it's one of the most valuable things as a consultant and coach, and just even sharing these kind of lessons with you is if you can avoid some of the mistakes in commercial real estate, it can literally save you hundreds of thousands, if not millions of dollars. And I'm not saying that as some sort of hype or whatnot, because I mean, this deal that I'm going to share with you and talk about, it could have been avoided, and literally I would be in a much different place had I known, and had I been leveraging the people that I knew in my network. But because of ego and pride and wanting to do it on my own, I screwed it up, and it cost me big time. So I'm going to share with you that deal, and I think you're really going to enjoy it. So once again, if you want the book, and you can go download it for free at clubsyndication.com. If you enjoy the show and you got some value out of it, I'd really appreciate a 5-star rating on iTunes, because that way it just kind of helps me get my my podcast to more people. Obviously that's kind of the objective. And if you're watching this live on Facebook right now, by all means, leave a comment below, and I'll do my best to respond today. So that's it for today's show. Thanks for tuning in, and I'll see you next week. Bye for now.